Want to know what the majority of investors are focused on at this moment? They're piling into the same expensive technology companies that have dominated headlines for months, believing the upward momentum will continue indefinitely. However, there are three established corporations hiding in plain sight businesses with solid fundamentals and long-standing brand recognition, currently priced at levels we haven't witnessed in quite some time. What concerns me most? Half a year from now, these investors will regret overlooking these obvious opportunities. I'm going to reveal three potential investments that might significantly impact your financial future. I've already invested my personal capital in two of these positions. Before we explore these opportunities in detail, please subscribe to the channel now. If you're interested in learning genuine stock evaluation methods rather than simply following trends, Finance Hype is your destination. Despite our name, we focus on substance over sensationalism, delivering authentic analysis for committed investors building long-term wealth. Stock number 1, Target Corporation. Let's discuss a company that's recently become a favorite target of financial critics. Target. Yes, the retail chain where quick shopping trips somehow transform into full cart purchases of unexpected items. I understand your skepticism. Target has dominated news cycles for negative reasons: shoplifting concerns, supply chain challenges, and political backlash. Share prices have declined approximately 25% year-to-date, sitting more than 50% below 2021 peak levels. However, value investors should find this situation intriguing. Looking at Target today, I observe not a failing enterprise, but rather a corporation operating over 2,000 locations nationwide, producing over $100 billion in annual revenue. This isn't a speculative venture hemorrhaging money, it's an established retail powerhouse with genuine customers, substantial cash generation, and consistent profitability. Current share prices hover around $95, translating to roughly $43 billion in market capitalization. That figure alone provides limited insight, so let's examine what truly matters. Target currently offers nearly 5% dividend yield. While partially driven by depressed stock prices, the company generates approximately $3 billion in annual free cash flow, distributing about $2 billion to shareholders. The stock trades at less than 15 times free cash flow and under 12 times earnings, quite appealing for an enterprise of this scale and stability. Profit margins have experienced pressure, declining from historical levels above 4% to approximately 3.5% recently. The critical question: is this temporary or permanent? Return on capital demands attention. It reveals how effectively management converts investment into shareholder value. Target's 5-year return on capital stands at 14%, demonstrating management's capital deployment competency. Revenue growth has stagnated short-term, but longer timeframes show steady expansion. The real issue is whether Target can successfully execute their recovery strategy. Consider this advantage. They're introducing services like membership-based same-day delivery, directly challenging Amazon while leveraging physical stores for hassle-free returns. No package waiting, no shipping uncertainties, just walk in, hand over items, finished. That represents genuine competitive differentiation in our digital age. If you believe Target will continue serving millions of customers a decade from now, the question becomes, what price makes sense? Running my analysis with conservative assumptions, 2 to 4%, annual revenue growth, modest dividend expansion plans and inflation, profit margins recovering to 3 to 5%, and fair valuation multiples of 17 to 23 times earnings in 10 years. I calculate intrinsic value ranging from $160 conservatively to $250 optimistically, with a midpoint around $170. At today's $95 price, the middle scenario suggests potential mid to high teen annual returns, including dividends. That's compelling for an established, stable operation. Take a moment here. If you're finding this analysis helpful, comment below indicating which stock interests you most. Share this with friends or family who could benefit from this evaluation approach. Too many market participants are operating without proper analysis, and that's precisely how wealth transfers from impatient to patient investors. Stock number 2, Nike. Moving to our second opportunity, Nike. This one stings slightly because I recall when Nike was Wall Street's favorite, trading above $180 per share several years ago. I actually stated then that it seemed overpriced and I'd consider it closer to $100. Critics called me unrealistic, insisting Nike would never decline that far. The reality? It didn't merely fall to $100, it dropped below $60. We're discussing nearly 70% decline from all-time peaks. This company now trades at prices lower than a decade ago. This distinction separates speculators from genuine investors. When masses flee, authentic opportunities often emerge. Nike isn't disappearing. This is the world's dominant athletic apparel and footwear corporation. They control brands like Jordan, partner with elite athletes globally, and sell products across over 190 countries. They've appointed a new CEO, Elliott Hill, emphasizing long-term transformation focused on sustainable growth and profitability. Simple question, will Nike still exist 20 years from now? Probably yes. Second question, will their revenue and profits exceed current levels? If you believe they'll grow and maintain dominance in athletic wear, the question isn't whether to consider Nike, it's determining the right price. Currently, Nike pays approximately 2.75% dividend yield. Free cash flow has declined recently to around $3 billion from a 5-year average closer to $5 billion, reflecting their turnaround phase. They trade at roughly 28 times current free cash flow, seeming expensive until you realize that based on 5-year averages, it's closer to 17 times. 5-year return on capital, 18%. Even amid recent challenges, gross profit margin remains 42%. For every sale, 42 cents per dollar is profit before operating expenses. That demonstrates pricing power. The stock's 5-year return is negative, down about 60% from prior levels. That's precisely what makes this intriguing. If you believe in mean reversion and that quality companies with powerful brands eventually regain market recognition, current valuations appear very different. Analyst projections anticipate earnings declining approximately 22% short-term before recovering to nearly $5 per share by 2030. Revenue growth estimates suggest 2 to 7% annually over coming years. Modeling with conservative assumptions, 3 to 7% annual revenue growth, profit margins recovering from depressed levels to 9 to 12%, and valuation multiples in 10 years between 19 to 25 times. Earnings, reasonable for premium brands with Nike's positioning. I calculate intrinsic values ranging from $50 low end to $110 high end, with roughly $75 midpoint. At today's $57, the middle scenario suggests approximately 12.5% potential annual return. For Nike's brand strength, global reach, and pricing power, that's attractive. Remember this, investing isn't about purchasing popularity. It's about identifying mispricing. When everyone loves a stock, you're likely overpaying. When everyone despises it, that's often when real wealth gets created, not always, but frequently enough to warrant attention. If you've stayed with me, I appreciate it. Hit that like button to help others discover genuine analysis instead of promotional schemes circulating online. The comments section is where real discussion happens, so share your thoughts on Nike. Stock number 3, Sprouts Farmers Market. The third opportunity deserves more attention. Sprouts Farmers Market, ticker SFM. This isn't Costco or Walmart, it's a specialty grocer emphasizing natural and organic products, and they've been executing exceptionally well. I previously owned this stock in the low $30s, watched it climb to $165, had shares called away through covered calls, then watched it rise further before collapsing back down. Emotional roller coaster indeed. However, Sprouts remains on my forever hold list, and it's now pulled back over 50% from peak levels. Currently trading around $80 with $8 billion market cap, it hit all-time highs of $182 last June. They operate only about 400 stores currently, but expansion plans target 1,200 to 1,500 locations eventually. This growth story remains in relatively early stages. What captures my attention is profit margin trajectory. 10-year average was approximately 4%, 5-year average closer to 4.7%, last year nearly 6%. For grocers to generate 6% profit margins is impressive. Why this matters: Sprouts has expanded private label offerings, and those products carry gross margins of 50 to 60% compared to overall gross margins around 39%. As customers increasingly purchase their branded products, quality items at competitive prices, profit margins should continue expanding. I genuinely believe this could become a 7 to 8% profit margin business over time. If realized, the stock will receive significantly higher valuations. Return on capital is solid for growing companies, sitting around 11 to 12%, indicating efficient expansion with new stores generating strong returns. Analyst projections are optimistic, forecasting earnings growth from approximately $5.30 per share currently to $8 per share in 4 years. Revenue growth estimates run 9 to 15% annually, driven by comparable store sales increases and new openings. Modeling Sprouts with 6 to 10% annual revenue growth, profit margins expanding to 5.5 to 7.5%, and valuation multiples in 10 years of 16 to 22 times earnings. I calculate intrinsic values ranging from $96 low end to $220 high end, with approximately $150 midpoint. At $80 today, even conservative scenarios suggest meaningful upside. The middle case implies very healthy annual returns. Here's a hard-learned lesson I want to share. Don't become emotionally attached to purchase prices. I bought Sprouts in the low $30s, now it's at $80, but that doesn't make it expensive. What matters is current business value and future direction, not historical purchase points. Too many investors make this error, seeing stocks double or triple and assuming they've missed the opportunity. Meanwhile, the underlying business may have strengthened and valuations remain reasonable or even cheap. Summary: there you have it, 3 distinct businesses. Target: a mature retail giant experiencing challenges but maintaining strong fundamentals. Nike: an iconic global brand beaten down yet retaining incredible pricing power and market position. Sprouts: a growing specialty grocer with expanding margins and substantial growth runway. None are the artificial intelligence stocks dominating conversations. None are cryptocurrency or meme stocks. They're authentic businesses with real cash flows and genuine competitive advantages. I must be crystal clear: nothing shared here guarantees results. Markets are unpredictable. Individual stocks can and do decline substantially. However, if you're willing to look beyond headlines, ignore short-term volatility, and focus on fundamental business value, you'll position yourself better than 99% of momentum-chasing investors. The key is conducting thorough research, understanding financials, knowing what you own and why. That way, when inevitable stock fluctuations occur, you're not panic selling at the worst moments. You're thinking like business owners, not speculators. Before concluding, I want your input. Which stock resonates most? Are you a Target believer anticipating their turnaround? A Nike supporter trusting the brand's resilience? Or intrigued by Sprouts' growth potential? Comment and let's discuss. If someone could benefit from this level-headed analysis, share this video. We're building a serious investor community at Finance Hype, starting with you. Thanks for following this breakdown. Now conduct your own research, make informed decisions, and invest with confidence and discipline.